Assalamualaikum and hi, my name is Juliasmin and here I am to share with you guys the comparisons between Islamic finance and conventional finance in terms of value proposition, structure, operational mechanism and the instruments offered by the banks.
Islamic finance is different from the conventional finance. Islamic finance comprises financial services that are specially designed to comply with the Islamic law or Sharia and guided by Islamic economics. It is based upon a commerce law known as fiqh al-mu'amalat. Meanwhile, conventional finance is a home financing scheme offered by financial institutions or banks which are not guaranteed by government agencies.
Value proposition is a promise of value to be given, communicated and acknowledged. So, if we speak about the value proposition of Islamic finance, it is totally different from the conventional one. The value proposition of conventional finance is geared towards consumer-friendly customer service that are meant to draw or attract more customers with the objective of profit maximization, plus socio-economic benefits for the customers. So in this case, there will be no need for socially responsible investment, which is gradually gaining grounds as a result of the recent global financial crisis. On the other hand, the Islamic finance industry is not opposed to profit making. Its value proposition is more of premium benefit to its customers' doorstep in a mutually beneficial way by partnership modes of financing. Reducing the impacts of harmful products and practices is another value for Islamic finance. Sharia laws forbid any investment that encourage industries or activities that are banned in Islam, such as riba or usury, gharar or uncertainty, and maisir or gambling, which are applicable to conventional finance. The basic difference between Islamic finance and conventional finance is the structure of how the bank is set up.
For conventional banking, the purpose of setup is to collect deposits and to give loans. These can be the shareholders' understanding of what it should be. A conventional banking is designed to have two main functions, which are collect deposits and provide loans. The arrangement is managed by a treasury function which tries to balance the returns to shareholders' funds. The modus operandi under conventional banking for collecting deposit is the shareholders give the capitals, the bank receives customers' deposits and invest them, and the interest received are distributed. Meanwhile, the modus operandi for providing loans is the customer requests for loans from the bank, and the bank borrows interbank funds, and the bank will lend the funds to the customer at an interest rate, and later the customer will pay the interest plus principals. But what about the Islamic finance? How an Islamic bank is meant to be set up is based on the idea of sources and applications of funds. There should be one flow between the deposits and financing or investment use of funds. It is one function where the customer deposits or investment pool is used to fund the financing portfolio or deploy into investment instruments from which returns are derived and recognized. Once the returns are determined, these returns are shared between the bank and also the customer. This profit-loss sharing structure demands a different way of managing the bank, although not all Islamic banks are able to successfully pull this off 100%, especially when the Islamic banks are still under the parentage of a conventional bank. Each Islamic bank has Sharia Supervisory Board (SSB) to ensure all activities are according to the Islamic principles. Islamic banking is not simply a replication of conventional practices, but there are significant differences in the operation of Islamic finance relative to conventional finance. There is a gap in the mechanism of funds mobilization from savers to entrepreneurs, which consists of accepting deposits and extending financing and investment. Now let's take a look from the point of deposit. Both institutions collect deposit from savers for reward. Both conventional and Islamic banking system give higher return and share higher profit on long-term deposits, and so does lower return and share lower profit on short-term deposits. The difference between these two lies in an agreement of sharing of risk and reward. Under conventional finance system, The reward is fixed and predetermined, and the total reward belongs to it as the total risk is borne by the bank. While under Islamic finance system, the reward is variable. Both risk and reward are shared with depositors through musyarakah, which refers to a joint venture that share profit and incurred losses together by both parties, and mudarabah, which refers to only profit sharing for both parties, and the losses suffered shall be borne by the capital provider. Next, let's see from the point of financing and investment. Both Islamic and conventional banking are providing financing to productive channels for reward. The difference between these two lies in financing agreement. Conventional banks are offering loans such as overdrafts, short-term and long-term loans for a fixed reward, while Islamic banks can only charge profit on investment because they cannot charge interest on loan. Basically, both Islamic finance and conventional finance mainly offer the same products or the same transactions, but what makes it different is the term used or its characteristics. These are some of the products offered by both banks. For example, under Islamic finance, we have ijarah. Ijarah, or also known as lease and hire purchase, is a contract under which the bank leases equipment to a customer for a rental fee. At the end of the lease period, the ownership of the asset can be transferred to the customer by mutual agreement at an agreed price minus the rental fees that has already paid. While under conventional finance, it has leasing, which refers to an usufruct of an asset is transferred to lessee with fixed installments. The ownership may or may not be transferred to the lessee at the end of the lease period, since it was stated in the lease agreement that the bank was granted unrestricted power to terminate the lease unilaterally.
In conclusion, we can sum up that both Islamic finance and conventional finance can be differed by value proposition, structure, operational mechanism, and instrument offered, and both Islamic finance and conventional finance have its own strength to stand up in this economic world.
Thanks for watching.